The average millionaire has 7 sources of income. Today, I'm going to go over 3 sources of investment income that are generating me more than $61,000 of passive income on top of $104,000 of year-to-date gains in the underlying assets. The bar charts and spreadsheet illustrate a breakdown of passive income and year-to-date asset gains from investing in dividend-paying stocks, cryptocurrency lending and staking, and writing covered calls and puts. My first source of income is income generated from my dividend-paying stocks that have appreciated an average of more than 24% year-to-date and pay an average of 2.8% dividend. The gains beat out year-to-date gains by SPY, the most popular ETF that tracks the S&P 500 by 6%, and the dividend yield more than doubles the dividend yield of SPY. This spreadsheet illustrates my current dividend holdings, which include Apple, Aflac, Best Buy, Cisco Systems, Goldman Sachs, IBM, Lockheed Martin, Lowe's, McDonald's, Microsoft, Pfizer, Prudential, Stag Industries, United Healthcare, Visa, and ExxonMobil. These 17 stocks represent some of the most established and stable companies belonging to 16 diversified industries, including life insurance, retail, communication equipment, oil and gas, banking and capital markets, information technology, aerospace and defense, home improvement, food and beverages, software, pharmaceuticals, tobacco, health insurance, and financial services. No more than 12% of my dividend portfolio is invested in a single industry to diversify the portfolio. Further, with the exception of Stag Industrial, which pays normal dividends on a monthly basis, all other stocks pay qualified dividends on a quarterly basis. The annual dividend payout of this portfolio is $11,579. However, with dividend reinvestment, which I strongly recommend, the dividend payments are reinvested into the underlying stocks, thereby further compounding returns. In addition to dividends, the underlying assets of this portfolio have appreciated by almost $77,000 year to date. I've added links to videos that analyze these companies and why I included these companies in my dividend portfolio. So feel free to check them out if you're interested in learning more about my dividend paying stock portfolio, as well as how to get into dividend investing. My second source of income is generated from staking and lending out my cryptocurrencies. For those of you who are unfamiliar with cryptocurrency, a cryptocurrency is a digital or virtual currency that is secured by cryptography. For example, Bitcoin, the most well-known cryptocurrency, has a finite amount, is a deflationary asset, and is often referred to as digital gold. Ethereum is a decentralized platform that enables smart contracts and applications, and the Ethereum token is used to pay for transaction fees incurred from using the platform. Currently, many cryptocurrencies can be loaned to third parties or staked to earn rewards, which are typically paid in the underlying cryptocurrency. And staking describes a process of participating in transaction validation on a blockchain such as Ethereum that is an energy-efficient alternative to mining. I currently stake or lend my cryptocurrency through Coinbase Pro, Kraken Pro, and the Celsius network. Coinbase is the most well-known domestic crypto exchange platform. Kraken is another established crypto exchange, and the Celsius network is a well-established crypto lending platform. I've included links to all 3 platforms in the description below if you're interested in learning more about these platforms. This spreadsheet illustrates my crypto holding and rewards from staking and lending my cryptocurrencies. In addition to Bitcoin and Ethereum, which are the 2 most heavily weighted and well-known cryptocurrencies, I also hold Chainlink, a decentralized blockchain oracle network built on Ethereum, Polygon, a layer 2 solution for Ethereum, Polkadot, an Ethereum competitor, and USDC, which is a stablecoin that is pegged to the US dollar. As you can see, the annualized passive income earned from lending and staking my cryptocurrencies is $7,375, and the average reward yield is 6%. Further, the year-to-date asset gains from these cryptocurrency assets is $27,250. There are some concerns with investing in cryptocurrencies. First, your savings are likely protected by FDIC, whereas your investments are likely protected by SBIC. However, there is no such protection in cryptocurrency on a federal level. Further, everyone can agree that cryptocurrency is underregulated by design, which is an open invitation for lawmakers to get involved, regulate cryptocurrency, and pass laws that hinder the growth of the industry while taxing crypto investors. Cryptocurrency itself is very safe, but cryptocurrency investment is a new frontier of investing, and new investors are susceptible to hacking, fraud, and generally having their money taken from them. And finally, the current tax code was not designed with cryptocurrency in mind. And this just gives lawmakers, most of whom only see cryptocurrency as another revenue generating source, of coming up with new taxes to regulate and to tax crypto investors. However, despite all of its issues, all you need to do is take a look at the APR of your savings account to understand why cryptocurrency is so alluring. Nowhere in traditional financing are you going to get more than 3% APR from lending money. In fact, last time I checked, I'm getting 0.01% APR on my super platinum top tier checking account. On the other hand, the APR for lending USDC, a stablecoin cryptocurrency that is pegged to the US dollar, is almost 9% on the Celsius network. Further, many cryptocurrencies have 10x, 100x, 1000x, or even 10,000x over the last few years. Moreover, I believe that the most established cryptocurrencies are here to stay, and I want to diversify my portfolio by investing in some of the most established cryptocurrencies such as Bitcoin and Ethereum. My third stream of income is generated from selling covered calls and puts. A covered call is a financial transaction in which the investor writing a call option owns an equivalent amount of the underlying security. For example, if I own 100 shares of Apple, I can sell one contract of covered call on Apple at a designated strike price and receive a premium for writing the covered call. If the price of Apple moves to or above the strike price at expiration, then I'm obligated to sell my 100 shares of Apple at the strike price. A cover short put is somewhat opposite of a cover call and is a financial transaction in which I write a put option and have the cash or cash equivalent to purchase an equivalent amount of the underlying security. For example, if I write one contract of a cover put on Apple with a strike price of $100 and I have $10,000 in cash or cash equivalent to pay 100 shares of Apple at $100, then I'm writing a cover short put. Now, before I go further, let me stress that for generating passive income, I'm talking about selling cover calls and puts, not naked calls and puts, which means selling calls without owning the underlying assets and selling puts without having the cash or cash equivalent to cover in case of assignment. This spreadsheet illustrates yet to expire cover calls and puts that I've written. As you can see, the current gain from the 5 cover short puts and 1 cover call is $19,703. The expiration date ranged from September 3rd, 2021 to June 17, 2022. Further, I would gain another $12,622 if these cover calls and puts expire worthless. My strategy for writing covered puts is writing at the money covered puts that are 1 year or more from expiration, so my gains will be treated as long-term gains for tax purposes if I do not close my positions within a year. This is what I've done with my QQQ March 2022 expiration puts with a strike price of $310 and my QQQ June 2022 expiration puts with a strike price of $320. I also write 30 to 45 day till expiration puts that are 5 to 10% out of the money, and that is what I've done with my Apple, First Solar or FSLR, and Goldman Sachs puts. However, I only write puts on stocks and ETFs that I wish to purchase at market price or at a discount. So in worst case scenario, I'm obligated to buy a stock or ETF that I want to buy from the beginning. And this spreadsheet shows the total numbers of puts and calls that I've written in 2021. As you can see, out of the 69 covered short puts I've written, 49 have expired worthless, which means I collected premiums 49 times without having to do anything. Further, I rolled my puts and the rolled puts expired worthless 7 times. What I sometimes do if I've achieved 75 to 85% of maximum profit and there's still a lot of time left until expiration is to roll the put, which includes closing the put and opening another put of the same equity but choosing different expiration or strike prices and getting paid a bigger premium. Further, on 2 occasions, I closed the puts I wrote by buying them back. I currently have 5 yet to expire put options that I plan to hold until expiration, which would net me another $12,622. Finally, on 6 occasions, my puts expired in the money and I was assigned the underlying equities, which are equities I wanted to buy in the first place. These equities include Goldman Sachs, Facebook, Lockheed Martin, Lowe's, Merck, and ExxonMobil. The total stock gains from these equities appreciating since assignment is $22,262. Here are 2 examples of 2 stocks that I wrote puts on and was eventually assigned. On January 15th, my Facebook put with a $260 strike price was assigned and I paid $26,000 for 100 shares of Facebook. Facebook is currently trading at $363 a share, so I made $10,351 from asset appreciation on top of being paid $445 of premium to write the put. On January 22nd, my Goldman Sachs put with a $300 strike price was assigned, and I paid $30,000 for 100 shares of Goldman Sachs. Goldman Sachs is currently trading at almost $398, so I made $9,800 from asset appreciation on top of being paid $339 of premium to write the put and receiving quarterly dividends. As with cryptocurrency investing, there are certain things an option writer should know or be familiar with before writing options. First, writing an option to open and receiving a premium is not as intuitive as buying an option and paying a premium. I have included a link to my video on how to write calls and put options, so feel free to click on the link and check it out if you want to learn more. Further, writing cover calls require an investor to own the underlying equity, whereas writing cover puts require the investor to have cash or cash equivalent to purchase the underlying equity in case of assignment. Moreover, unlike dividend investments, option decay is not linear, so it's hard to predict the gains and losses on a day-to-day basis. And finally, every call and put writer, regardless of experience, needs to be mindful of not over-leveraging. So if you're just starting out, do not over-leverage and do not write naked calls and puts. Let me know in the comments below where your investment income streams are. And as always, thank you for watching, and please check out my other videos where I trade stocks, options, futures, and cryptocurrency to achieve different goals, including building a dividend-focused portfolio with market-beating gains, 10xing my gains, and 50xing my gains.